We love to think of financial markets as these perfectly rational, data-driven machines. But what if they're not? What if they're actually driven by something, well, a lot more human and a lot more flawed? Today, we're going to dive into how our own psychology and the AI that's starting to mimic it is totally rewriting the rules of finance.
For decades, the gold standard was this idea of the rational market. An elegant, clean model where everyone makes subjective, efficient decisions. But reality is a whole lot messier. So welcome to the behavioral market, a world driven by human emotion, chaos, and subjectivity. The real question is, where does that perfect theory first start to crack? Turns out, it starts with us.
So that first big crack in the foundation of a perfectly rational market, it isn't hiding in some complex algorithm or a Wall Street secret. Nope, it's right inside our own heads. We're talking about the very real, very hard limits of the human brain. Imagine trying to take a sip of water from a fire hose. That's kind of what processing financial data can feel like, right? Our brains just don't have unlimited bandwidth. And when we get flooded with really complex information, our ability to think clearly starts to break down. There's a name for this. Researchers call it cognitive load. And this isn't just some little psychological quirk. It has huge real-world consequences. When we're under a high cognitive load, we do something called selective attention, which is a fancy way of saying we just ignore the complicated stuff. We also make more mistakes. And what's really fascinating is that some studies suggest companies might even use this against us, strategically making their reports more complex just to bury the bad news. And the result of all this? Get this. Just a single standard increase in how complex a company's disclosure is can cause that stock to be mispriced for 23% longer. That is a massive inefficiency in the market, and it comes directly from the limits of our brains. So if our own brains are the problem, could an artificial brain be the solution? Well, this is where the story takes a really interesting turn. What if, instead of using AI to be perfectly rational, we actually used it to perfectly imitate our irrationality? So the big question researchers are asking now is this: can we build an AI that doesn't just trade, but actually thinks like a human trader, with all of our biases, our gut feelings, and our mental shortcuts? The goal isn't to create a perfect, flawless robot investor. It's to create a psychologically plausible one that's basically a digital mirror of us. And one of the most exciting results from all this research is a brand new model called the FCL agent. It's this really unique hybrid AI that's been specifically designed to capture the messy, complicated reality of how humans actually make financial decisions. So how does this thing work? Okay, so the secret sauce for the FCL agent is this really clever division of labor. It has what you could call an LLM brain, that's a large language model, and it handles the human part, deciding whether to buy or sell based on the context, the news, the sentiment. But for the cold, hard numbers, how much to buy and at what price, it switches over to traditional rule-based logic. It's this hybrid approach that lets it simulate incredibly complex human biases, like our very, very strange relationship with loss. This is such a perfect example of a classic human bias called loss aversion. So is that stock at $350 a win or a loss? I mean, objectively, it's just a number. But psychologically, it completely depends on your reference point. Did you buy it at $300 or did you just watch it peak at $400? This new kind of AI agent can finally simulate this kind of emotional, context-dependent thinking. But here's the thing. Our biases don't just operate in a vacuum. It's not just our psychology affecting the market. The market also affects our psychology. It creates this powerful feedback loop, an echo chamber that can change not just what we believe, but the actual reality of the companies we invest in. This is the core idea behind a really powerful theory called reflexivity. Basically, it argues there's this constant two-way street between our beliefs and reality. Our perceptions of a company shape its stock price, and then that stock price circles right back around and influences our perceptions, and can even change the fundamental value of the business itself. You can break reflexivity down into two parts. First, there's the cognitive function. The market feeds you information, and that shapes what you believe. But then there's the manipulative function. Your actions, driven by those beliefs, turn around and actually shape the market. And this is the key takeaway. Market prices aren't just a passive mirror of reality. They are an active participant in the game, capable of changing the very reality they're supposed to be reflecting. Okay, so let's pull all of these threads together. With everything we've talked about, what does this new, more complete, and honestly, more complex picture of the market actually look like? Our new framework kind of looks like this. It all starts with cognitive load, the simple fact that our brains have processing limits. Then we can use these new LLM agents as a sort of digital mirror to model the biases that pop up because of those limits. And finally, reflexivity shows us how those biases create these intense feedback loops that don't just interpret the market, they actively shape it. The big takeaway here? Markets aren't simple machines. They're complex, adaptive systems, just like the humans who built them. And all of this leaves us with one critical, kind of mind bending question for the future. As these incredibly sophisticated AI traders become more and more common, will they just learn to copy our own flawed psychology? Or will they evolve and develop entirely new, purely artificial biases, shaping our financial world in ways we can't even begin to predict?